Good morning, and welcome to today's webcast, Investing Insights, Macro and Markets. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters. From Moss Adams, Michelle Walker, Chief Investment Officer, and Dominic, Cellitti, Senior Financial Advisor. With that, I'll turn it over to Dominic to get us started.
Good morning, everyone, and welcome to the first installment of our quarterly webcast, Macro and Markets. I'm Dominic Cellitti, Senior Financial Advisor with Moss Adams Wealth Advisors, and I'm joined by our Chief Investment Officer, Michelle Walker. We're excited to kick off 2024 with this investment update covering the economic landscape, the markets, and where we see opportunities.
Thanks, Dominic, and thanks everyone for joining us today. As a quick overview of what we'll be covering today, we're all aware that the past several years has been unprecedented, marked by a global pandemic and economic shutdown, extraordinary amounts of stimulus, then inflation followed by an aggressive monetary response to that inflation. At this point, we're finally seeing a normalization of the economy, and as we enter into 2024, we expect to see the inflation continue to decline towards the Fed's 2% target and consumption to return to more normal levels. Although we expect some continued volatility as the economy slows due to the lagging effects of Fed tightening, we believe the resiliency in the labor market, as well as the potential for Fed easing in 2024, could guide us toward a softer landing than was previously expected. In light of this view, we see many attractive opportunities in both stocks and bonds, as well as select parts of the private investment universe, and we'll touch on these as we go through the presentation.
To get started, 2023 felt like the year that seemed to defy all expectations. But before we get to 2023 specifically and what's to come in 2024, Michelle, can you explain how we got to where we are today in this post-pandemic economy?
Sure, yeah. So in mid-2021, a worldwide increase in inflation emerged, with many countries seeing their highest inflation rates in decades. There were a variety of causes, including pandemic-related economic dislocations, supply chain disruptions, extraordinary fiscal and monetary stimulus by governments and central banks around the world, as well as inflationary consequences from the war in Ukraine. Recovery in demand through 2021 led to historic and broad shortages across important sectors like commodities, semiconductors, energy, and construction, among others. The war in Ukraine drove the price of global oil, natural gas, fertilizer, food prices, and many other things higher, exacerbating the situation. As a result, most of the major central banks around the world responded by aggressively increasing interest rates. The Federal Reserve began raising rates in 2022, and by the end of 22 had hiked 425 basis points. The combination of inflation and rising interest rates was not kind to the equity markets, and all major indices closed down for the year ended 2022. The S&P 500 finished down 19.1%. The more volatile Russell 2000 small cap index closed down 21.6%, and the tech-heavy NASDAQ fell 33.1%. The fixed income markets also suffered under the rate hiking regime, and the Bloomberg Ag closed out 2022 down 13%.
So to put that last point into some more context, this was definitely an area that made 2022 returns and the market feel even worse than a typical down year or even a bear market. 2022 really left investors with nowhere to hide. For some historical context, the only other time both stocks and bonds have both been down on an annual basis was 1931 and 1969. So the unprecedented nature of a lack of cushion from bonds, as well as not just a down year, but the worst year on record since the Ag Bond Index started tracking the bond market, led to increased bearish sentiment across all asset classes. So I believe this is an area a lot of professionals, investors, and clients alike learned about the importance of duration risk. Given the lack of yield in general over the past 15 years, investors and institutions really stretched to find yield, which only increased these losses they experienced in 2022. And even though a lot of these losses were on paper and we made up as bonds come to maturity, it certainly did not feel good. And as we will discuss, it impacted other areas of the market.
Exactly. Yeah, so the cause of all this pain was the fastest rate hiking cycle by the Federal Reserve in 4 decades. Over the course of the 22 to 23 cycle, the Fed raised rates by an extraordinary 550 basis points. Ultimately, the rate hikes were successful in cooling the economy, and inflation did peak in June of 2022, with the CPI, or Consumer Price Index, printing more than a 9% year-over-year return or rise. This was the largest increase in 40 years. The inflation rate in the United States and elsewhere did slow in the second half of 2022 and continued into 2023. And as of this last December, the CPI had declined to 3.1%. And as you can see, the stock market recovered, ultimately bottoming in October of 2022. Heading into 2023, the markets came out of the gates with a more bullish tone driven by declining inflation, but also enthusiasm around technology, and in particular, advances in AI, or artificial intelligence.
So if someone just saw an annual return for the markets at the end of 2023, they would think, this was a fantastic year, and it was. Historically speaking, this shouldn't be a surprise, though. On the heels of such poor returns in 2022, back-to-back down years rarely ever occur. So you just said we started the year out strong, and we know we ended the year strong, but clearly there were some speed bumps along the way. The first one was the regional bank panic. So, Michelle, can you walk us through what happened in regional banks in March and really pause the market's initial momentum for the year?
Sure, yeah. So that rapid pace of interest rate hikes I was talking about had created what we would call a duration mismatch on the books of some regional banks. And what that means is that assets held for customer deposits had been invested in longer dated treasury bonds that had significantly declined during the rate hikes. So over the course of 5 days in March, 3 small to mid-sized U.S. banks failed, triggering a sharp decline in global bank stock prices and a swift response by regulators to prevent potential global contagion. Silicon Valley Bank was the first to fail. After selling a portion of its hold-to-maturity treasury portfolio at a significant loss, its depositors lost confidence in the regional bank, and they swiftly flocked to pull their deposits. The bank's depositors were primarily technology companies and wealthy individuals holding large deposits. And the concern was that the balances exceeding $250,000 were not insured by the Federal Deposit Insurance Corporation, or the FDIC. So as depositors demanded their money from the bank had to sell more treasuries at a loss. Ultimately, they could not keep up with the request for redemption. During the same time, Silvergate Bank and Signature Bank also failed. And both of these banks had added complexity with significant exposure to cryptocurrency. Additionally, First Republic Bank was bought in distress by JP Morgan at this time. In response to the crisis, the 3 major U.S. federal bank regulators announced a joint communication that extraordinary measures would be taken to ensure that all deposits would be honored. The Federal Reserve established a bank term funding program to offer loans up to 1 year to eligible depository institutions pledging qualifying assets as collateral. By March 16th, large interbank flows of funds were occurring, and the Federal Reserve discount window liquidity facility had experienced approximately $150 billion in borrowing from various banks to shore up their balance sheets.
So again, to put this into some context for the individual, I think it's important to understand that people react from what they know or the most recent experience, which for a lot of people is the great financial crisis, and prior to that, the savings and loan crisis. So it's not too surprising that the first inclination for investors and consumers was, how is this going to bleed into other areas of the financial sector and eventually the economy? In this instance, with any, as with any run on the bank, panic begets more panic, and increased withdrawals create more stress, and the original problem just gets worse. One differentiator this time was the virtual nature of the run on the bank, given more accessibility to withdraw funds than in the past. So ultimately, clients moved deposits to larger institutions, though, or different non-cash instruments and other short-term investments. But larger institutions were not only better capitalized, they also had less balance sheet risk. So it really fortified a lot of that flight of the cash to these too big to fail institutions and really isolated the problem. I think as stressful as this was, the silver lining here was that there's definitely a lot of lessons learned, in regards to safety of cash and other assets. And again, the past decade plus, we've had no yields on treasuries and bonds. So there's a lot of complacency on the safety of our most liquid asset, which is cash. And this led to individuals and corporations alike stockpiling a lot of that cash in the bank without really assessing the safety of where those assets were kept. So typically we assume cash is the most low risk asset and rightfully should be, but events like this remind us that we need to evaluate things as simple as our cash holdings even. Again, I remember, when this was happening last March, and still to this day, we have a lot of conversations still around how to structure cash for clients, whether it's an emergency fund, assets set aside for specific liabilities or excesses in a business's operating account. And we certainly want to maximize, the yield we're able to attain for clients, but we also want to minimize risk and assess insurance coverage on these types of things, given other liquidity risks like we saw in March. So utilizing short-term treasuries and other instruments at our disposal really can mitigate a lot of the things that we saw in the spring. So just as an aside here, we do have more information on cash management strategies in a white paper that our firm put out last year in light of the regional bank panic. So let's move on to inflation. Michelle, we all know the story of 2022 and 2023, and really the underlying theme to a lot of our concerns we've had recently is inflation. So where are we in the battle against inflation?
Yeah, so as I mentioned earlier, inflation has been declining since the peak reached in June of 2022. Rising interest rates have been successful in slowing the economy, and demand has waned, in particular for the purchase of goods. Though the services sector continues to be strong, normalcy is returning to the supply-demand picture, and inflation is definitely on the decline. It is important to note, though, that even though the rate of price increases or inflation is declining, prices are settling at levels that are much higher than they were prior to the pandemic, which has been hard on the average consumer.
Yeah, and I think this is an important point to make, why the consumer probably has felt more stress, and at times sentiment's been more negative really than reality. Prices are elevated and they're going to stay that way. We essentially got a decade of inflation in 2 years or less, and a lot of consumers anchor to those previous prices, which explains a lot that we psychologically, see prices as one thing and they change so drastically that pain, even though it was caused by a certain issue, really is not going to go back to the previous anchoring basis that it had. Another note on inflation would be the cause. And now that we have the benefit of hindsight, investors certainly like reasons why things happen. And in this instance, there was a lot of finger pointing for the cause of inflation and whether it would be transitory. And with a lot of the data and experience being behind us, I think we can point to the fact that it was a combination of all those things, supply chain issues, converging with accommodative monetary and fiscal policy. We had unprecedented demand at a time where there was a lot of stimulus money and zero interest rates, and that was leading to even more spending. So the supply chain was brought to its knees. And now that we've had a lot of those issues easing and demand reining in, a lot of that excess has kind of been built out of the market now. We're just seeing a lot of the normalization at this point. So the biggest call in the beginning of 2023, as everyone knows, was for a recession. At the beginning of the year, I believe about 70% of economists predicted we would have had a recession. And at one point, there was a 100% chance of a recession. So how did economists get it so wrong, Michelle?
Yeah, that's right. So last year at this time, most economists and finance experts felt that the Federal Reserve's battle to tame high inflation with rapid interest rate hikes would trigger high unemployment and a recession, as it had back in the 1970s. And the failure of the U.S. economy, to fail actually in 2023 has been one of the biggest surprises of the year. The Fed's rate hikes did trigger some pain in many parts of the economy. The commercial real estate market is struggling, and a lot of tech workers lost their jobs. We already mentioned the banking disruptions that occurred earlier in the year last year, but the hurt in certain sectors didn't spread to the real economy, the realms where regular Americans work and spend money. Most of us just kept working and spending money anyway. So the resilience of the consumer, who accounts for about 70% of all domestic economic output, has really been the key in keeping this economy afloat, despite all those dire forecasts. One reason the consumer is outperforming expectations has been a resilient labor market with strong wage growth. The unemployment rate has surprised economists, holding in below the 4% level, and wage growth is finally above the rate of inflation. The pace of increase in consumer prices has fallen from around 9% annually in the summer of 2022 to the low threes now. Meanwhile, wage growth is running above inflation at 4.3%, according to the most recent labor market data. Corporate America has held its own, and companies have confounded the experts by continuing to grow and hire workers in the midst of rising rates. They have right-sized their balance sheets and cut costs, preparing for recession. Lowered expectations and earnings guidance provided by company management has led to the ability for them to meet their lowered forecasts and causing upside movement in their stock prices. This was particularly true for the tech sector, which was depressed and very under-owned coming into 2023 after a pretty brutal sell-off in 2022 for the tech-heavy NASDAQ.
Yeah, I think there's an interesting and important point to make here in regards to the true impact of the Fed raising rates. So consumer and corporate balance sheets were largely reinforced and optimized, and it's not much of a surprise. We had record low interest rates, and a lot of people and institutions took advantage of that. So it was hard for the Fed's restrictive policy to really result in turmoil when households refinanced ultra low rates, which are fixed. So now they are saving more cash, if anything. And once rates rose, now they're earning a lot more on that cash. So corporations did the same thing, refinanced corporate debt to ultra low rates, and their treasury departments are operating effectively like banks, paying considerably less on their debt than they're earning on their cash. Not every part of the economy could take advantage of that, but it definitely provided a lot of cushion to what could have been a more destructive rate environment. So we're seeing that the Fed's actions could not touch all parts of the economy. But with that in mind, we often have varying or even arbitrary definitions for events that occur in the economy or markets. Is it possible that we did have a recession and maybe it just looked differently or was defined differently or happened in certain areas of the market but not others?
Yeah, definitely. So as it relates to that much expected recession that never arrived, looking backwards, perhaps we did have it in the first half of 2022. In the US, the official arbiter of the economic cycle is the National Bureau of Economic Research, or the NBER. While a common definition in the media defines a technical recession as 2 consecutive quarters of negative GDP, which we did in fact have at the beginning of 2022, the NBER emphasizes that a recession involves a significant, widespread, and prolonged downturn in economic activity. So beyond that rule of thumb on negative GDP, they also consider things like non-farm payrolls, industrial production, and retail sales, among other indicators. Due to the strength, particularly in the labor market, the NBER did not call an official recession in 2022, even though we did meet that simple criteria of 2 back-to-back negative GDP prints. Another explanation is that we simply had rolling recessions throughout 2022 and 2023, and there's no need for an official macro recession to call the restart of the cycle. Rather than a simultaneous and comprehensive downturn, a rolling recession is more of a staggered response to shifting dynamics such as tighter financial conditions. As the U.S. economy has evolved from a heavy industrial to a more service and financial-oriented economy, the impact on the business cycle, inflation, and monetary policy may just have become more uneven. So for an example, in early 22, the most rate-sensitive part of the U.S. economy, housing, experienced a downturn in aggregate demand as a spike in mortgage rates constrained affordability. Many in the mortgage industry would say today that housing has already gone through its recession and has already exited it. Then later in 2022, the consumer sector experienced pockets of inventory gluts as consumption patterns shifted from goods to services at the same time the supply chain recovered. Heavy price cutting was required and margin pressures ensued, causing a significant downturn for the producers and sellers of goods. And shortly after that, the elevated cost of capital began to weigh on the information technology sector that had overexpanded during the work from home surge of the pandemic. Layoffs were frequent in the tech space, though many displaced workers found a new job relatively quickly.
Yeah, this was a time when it started to feel like we were on the cusp of or in a recession. I remember layoffs being announced almost every day or part of every earnings call, and executives started using the term the year of efficiency on those calls to explain that cost cutting and really a return of responsible balance sheet management, if anything. If we look at it in its context, though, it was definitely isolated to the sector at this time, and a lot of that excess hiring as employers came back to really a position of power in the hiring process, which was not the case in 2020 and 2021.
Yeah, so exactly. So this rolling recession kind of marched on. So in March of 2023, the technology sector, gladly handed the baton of the rolling recession over to the regional banks, which, revealed some of those unintended consequences we talked about earlier of higher rates. While regional banking is now adjusting to a new regulatory regime with tighter lending standards, the uncertainty at the current moment is in the commercial real estate sector. There's clearly a common economic thread across these sectors, but much of their adjustment has been what we'd call idiosyncratic or happening on a rolling basis. So far, the rebalancing of these industries has not been systemically large enough to bring down the broader economy. And so an increasingly popular view amongst economists has been that perhaps this time, given the rolling nature of the recessions, the Federal Reserve may just be pulling off a soft landing.
All right, so inflation's being reined in, or at least seems to be on the right path towards the Fed's 2% target. Excesses in multiple areas of the economy are abating, spending and growth are slowing, albeit normalizing. As an advisor, I look to the market and it says the Fed is done raising rates, but is the Fed themselves saying that? And if so, when do we get cuts?
Yeah, so a definitive turning point came in the markets last December following the Federal Reserve's policy meeting. The Fed kept rates steady as was expected, but the market's focus quickly turned to the summary of economic projections. And that showed that median policymaker projections were for 75 basis points of easing in 2024. In the Q&A that followed the meeting, Jerome Powell said that the Federal Reserve is willing to cut rates even if the U.S. economy doesn't dip into a recession in 2024. It could just be a sign that the economy is normalizing and doesn't need the tight policy, he said. Well, the markets loved this, and both stocks and bonds embarked on a significant and broad rally into year end, basically celebrating the end of the tightening cycle and looking forward to rate cuts in 2024.
Yeah, I think it's important to note the modern Fed communication strategy is pretty interesting, and investors and market participants may still underestimate the power of the Fed's words. It really wasn't until Chairman Bernanke in the post-Great Financial Crisis that the Fed began these regular press conferences the way they have them today. In the past, decisions were made behind closed doors, and markets would not find out until market operations actually occurred. So it could be weeks to find out if the Fed had made any decision at all, and that's even if you were looking at market internals. So it definitely shows that we need to heed their words and look at what the market is telling us to get a picture of how their words are being digested by those market participants. The adage, don't fight the Fed, is certainly still in play, but sometimes the Fed uses the market to do its work for it. So with all this in mind, Michelle, what themes are we focusing on for 2024 and ahead?
Yeah, so the 10-year Treasury hit 5% in mid-October of last year. But by December, following that dovish pivot I just mentioned by the Fed, rates fell back below 4% on the 10-year. As Dominic mentioned, the Fed uses their words to cue the markets, and in this case, the market listened, and the market is now pricing in cuts for 2024. So with the hiking cycle in the rearview mirror, investors have turned their attention to when rate cuts will begin. History does provide a reasonable starting point for this discussion, with the first cut coming typically 5 to 8 months after the final Fed rate hike on average. The duration of this period, known as the pause, has ranged from just 1 month in the 1980s to as long as 15 months in the mid to late 2000s leading up to the global financial crisis. If July of last year was, in fact, the final rate hike, the pause has already been 6 months. The Fed funds futures are pricing in about a 50% probability today of the first cut being in March of this year. And that would make it about a pause of 10 months. And that would be really in line with what the Fed has been saying, higher for longer. However, each cycle is unique, and the length of the pause is driven by conditions at that time. Once the most recent hiking cycle was underway, the bar for a pause was moderating inflation towards a more credible path towards 2%, which we did see. But we believe the criteria for rate cuts will be a little bit different. And there are really two types of cuts. Those that help drive the stance of monetary policy closer to neutral, and we would call that more fine tuning, where the Fed cuts because it can. Then there are the kind of rate cuts that bring monetary policy into accommodative territory. And that's a more serious scenario where the Fed cuts because it has to.
Yeah, so that second type of cut would usually be a cause for concern since, they've historically been driven by a rapid decline in economic activity, a recession, or an exogenous event, which we're all familiar with. If the Fed feels that they need to step on the accelerator, there's clearly a reason. They're usually trying to get away from something bad. So what kind of cuts we ultimately get depends on how well the Fed threads this needle. Will they stay restrictive too long and tip the economy over, or will they be able to tweak rates lower for a soft landing and the start of a new expansionary phase? They're often criticized for overstaying their welcome on both ends of the cycle, but the recent language seems to acknowledge this risk in our current rate cycle, so maybe this time is different.
Yeah, agreed. And an important thing to consider is that monetary policy is evaluated in real terms. So that's the Fed funds rate less inflation. And this means that as inflation cools, the Fed may need to cut rates to just not get incrementally more restrictive. So beyond modestly cutting rates for that reason, we believe the catalyst for more substantial rate cuts would probably have to be job losses. And while the labor market is showing some cracks, job creation remains robust, suggesting significant rate cuts are probably not yet on the horizon. So our view is that the Fed will make those more incremental fine-tuning type cuts, and a soft scenario landing is more probable. But regardless of when the first cut occurs, this pause is typically a favorable period for equities, and small caps and more economically sensitive areas of the market tend to lead when rates are declining, and that's exactly what we've seen. The Russell 2000 small cap index gained 20% since November 1, while the equal weight S&P gained 17%. Lower rates is also good for long duration assets, and we've seen the NASDAQ also outperforming, up 23% since the beginning of November. For fixed income, the pause also tends to be a favorable period as the bond market anticipates rate cuts in advance. And the Bloomberg Ag has rallied 7% since the November 1 low.
So let's move on to the consumer. And considering consumption is 70% of GDP, when thinking about the trajectory of the economy, it's important to consider the health of the consumer.
Yeah, the chart to the left shows the consumer savings rate as a percentage of disposable income. It exploded in 2020 as pandemic-related fiscal support resulted in increases in disposable income. At the same time, health-related economic closures and social distancing led to a significant drop in household spending. Additionally, for those who owned a home, refinancing at the low rates available during the pandemic created a boon in disposable income. And though the savings rate has been declining, the consumer still looks in pretty good shape. You can see at the bottom right hand, the revolving consumer credit as a percentage of income has risen a little bit, but is still quite low, considering its history. And flipping next to the Conference Board survey, I'll just say that in December, it was a surprise that we got consumer sentiment really on the rise, with expectations of inflation declining quite a bit and consumers saying they plan to spend more in the coming year.
All right, so let's talk about real estate. So one of the areas that's been impacted by rates the most that we're all familiar with is the real estate market. So it's been interesting to see the impact on the residential market has somewhat bucked the trend, while the commercial real estate market, which we'll talk about next, is keeping a lot of economists and investors up at night. 2020 and 2022 saw a massive refinancing of household debt at historical lows. So this locked in a lot of fixed rates for decades, regardless of what new mortgage rates went to. So majority of those homeowners have sub 4% mortgages. So as you can see here, the median sales price really hasn't been too impacted by that. Sellers are just not coming to the market. Homeowners are not being forced to sell for any reason and holding on to those lower rates. So as rates come down, we may not just see benefits from the incremental Fed cuts, but also narrower spreads for mortgage lenders. So on this next chart, we see that spreads are at historical highs. So this is the premium a homeowner pays on top of the 10-year treasury. It's largely from rates being so volatile and originators demanding more risk to cover that volatility, as well as a lot of refinance risk. We're at, not all-time, but multi-decade high and likely to fall from there. So there's a lot of refinance, which is reinvestment risk, the purchases of those mortgages. In contrast to this, the commercial real estate market has been sounding a lot of alarms for the past year. Unlike residential real estate, commercial real estate terms generally to a lot more refinancing, which is creating a lot of risk in the market. There's approximately 1.5 trillion maturing in the next 2 years at 2 to 3 times of where rates are at right now. So that could lead to a lot of equity needing to be brought to the table, a considerable amount of defaults potentially, or if cash flows are able to sustain it, just increase pressure on the balance sheets of those real estate firms. So this also brings a resurgence of risk to regional banks. Regional banks hold 20% of their assets in commercial real estate, compared to about 4% of big banks. So if we see a wave of defaults, this certainly could apply more pressure to those smaller banks that already had some issues in the spring of 2023. So to kind of wrap things up, Michelle, with everything we discussed, what are areas of the market that we feel are the most opportunistic for 2024 and beyond?
Yeah, so to recap, our base case for 2024 is continued resiliency for the consumer and the jobs market. While the economy should continue to cool, in our view, recession odds have significantly declined. We see the current environment as supportive for both stocks and bonds. In the stock market, we believe there will be a continued rotation toward the more rate-sensitive areas of the market, like small caps, cyclicals, and financials as rates decline. Predictability and stabilization of rates lowers the risks in these areas, and they are cheaper from a valuation perspective. Additionally, we continue to be constructive on the secular tailwinds of technology. For the fixed income markets, even with the recent rally in bonds, rates are still very attractive versus history. If inflation continues to cool and the Federal Reserve is able to lower rates, we should see continued positive performance from bonds. And one last area of, oh, sorry, go ahead.
Go ahead.
One last area of focus for us in 2024 is in private investments, where we see a lot of opportunity. For qualified investors, private investments can be a great addition to a portfolio as they can provide different and uncorrelated returns. You can find very strong managers and the possibility of enhanced returns to the illiquidity premium of private capital. Areas of the private markets that we like a lot are private lending, private infrastructure, and select parts of the private real estate.
Yeah, definitely an area of opportunity that we are excited to work on and consult with for clients and their portfolios. But given the characteristics Michelle mentioned and the uniqueness of every investor's personal balance sheet, how we allocate and implement a private investment strategy plan typically requires experienced advisory team, and to make sure that you're really adding value to the portfolio and not simply adding complexity. So with that, we're a little bit over time. Michelle and I would like to thank everybody for joining. Any questions we received today, we'll follow up on individually, and our contact information, which has been provided. Anybody with additional questions, feel free to reach out to us directly.
Thank you.
Thank you, Michelle and Dominic, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this as your survey feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.